So now we're going to look at bonds payable, but issued at a discount. And if you have looked at the one we did where they're just issued at face value, this is going to, it'll make this one a little bit easier if you understand that. Okay, so we're going to say these bonds were issued at 98. Okay, so issued at 98, and we know that that means 98% of face value. So on 1/1, when we issue those bonds, we're going to go cash. But how much cash are we going to get? Well, we're going to do the face value of the bond of 100,000 times 0.98, because they were issued at 98, gives us $98,000. Okay, so we get cash of 98,000. We are going to have to pay back the bond 100,000. So we can see that we have a discount on bonds payable of the difference, 2,000. So let's put this on our T accounts. We got 98,000 cash. We've got a bond payable of 100,000. And now, you see how I planned ahead and put in this little T account for a change? Okay, so discount on bonds payable. And that is also a debit for $2,000. Okay, now let's think about this a little bit. If you lent $98 to somebody, you lent $100 to somebody, and they were only going to pay you back 98. And you were charging them interest, that would increase your cost of borrowing, because not only would you have to be, paying the interest, but you would also not have all the full amount of the money to work with. So basically, when we are issuing bonds at a discount, it's going to increase our cost of borrowing, which translates into it's going to increase the interest expense on the bond. So let's see how that happens. And we'll see how that happens when we make the first interest payment. So we're going to have interest expense, but with each interest payment, we're going to amortize some of this discount. All that means is we're going to take some of this discount and add it to the expense of each interest payment. We'll see how that's done. Okay, so we're going to have interest expense. We're going to pay cash. Okay, the amount of cash we pay is going to be the same whether the bonds are issued at a discount, a premium, or at face value, because the interest payment is based on the face value of the bond and that stated interest rate. So the cash we pay out is going to be $5,000. But let's look at what happens here. So we've got interest expense so far of $5,000, and we've paid out cash of $5,000. But we got to deal with this. We got $2,000 discount on bonds payable, and we're going to amortize some of that with each interest payment. Well, how many interest payments do we have? Well, it's a 2-year bond, 2 interest payments each year, so that's 4. Your typical bonds on the homework are going to be maybe 10-year or 20-year bonds. They'll have 2 payments each year, so you'll have, bigger numbers to work with. But here, we're just going to take that 2,000 discount, divide it by 4, and so we're going to amortize $500 of that with each interest payment. So how does that work? Let's look. We have to credit the discount to reduce it, okay, because we're going to be getting that down to 0 over the life of the bond. So our discount on bonds payable is going to be our credit entry. And look at what that does to our interest expense. Instead of being $5,000, our interest expense is now $5,500. Cool, huh? Okay. So let's finish this off. We posted this. We have to post the other $500 to interest expense. So the interest expense for each bond, when it's issued at a discount, is going to be higher than if it were issued at face value. Okay, so now I don't have room to do all the journal entries here, but we would do, 3 more journal entries like that. We'd do it at 12/31, we'd do it for the next year, and then at the end, by the end of the time, okay, so we would pay, is the first year, is the second year, all the cash that went out for the interest payments. we would do the same thing each time. We'd have the interest payment, plus we'd be amortizing some of the discount each time over the life of the bond. You see why a 2-year bond is nice here instead of a 10-year bond, okay? And so we would have, I have room to do this part. Did I do too many? 1, 2, 3, no, perfect, okay. So you can see that by the maturity date of the bond, this is 2,000 minus 2,000, so that's, you've amortized all of the discount over the life of the bond. You can see when you add up all the interest expense, instead of being 20,000 as it was when it was issued at face value, now your interest expense total on the bond is going to be 22,000. So your interest expense when the bond is issued at a discount is the amount of the cash payments, the total cash payments of 20,000 plus the discount. Okay, and you know, at the end of the bond, you would be left with a zero balance in the discount account, and so you could simply pay off the bonds. Okay, just like we did, and that's assuming we do that at their maturity date. Okay, so that's at a discount, and now, or next, we'll see how it works when we do bonds that were issued at a premium.